So, welcome to this explainer. I want you to imagine, just for a second, that you are the chief financial officer of a rapidly growing company. You've got limited capital to play with, right? And your desk is just absolutely piled high with proposals for new projects, new product lines, new investments. How do you actually choose? Well, today, we are focusing squarely on the ACCA Financial Management syllabus to help you master the ultimate investment appraisal toolkit. We're going to be looking at the precise tools and the hard rules you need to make decisions that literally build value.
Okay, let's dive into this. We'll kick things off with the wealth maximization objective. Then we'll explore our gold standard, NPV, followed by the percentage player, IRR. After that, we'll resolve any conflicts between the two and wrap up with the absolute rules for relevant cash flows.
Section 1. The Wealth Maximization Objective. Now, before we even think about evaluating a specific project, we have to ask, what is the true underlying goal of your financial decisions? I mean, it's super easy to just jump straight to, well, making a profit, obviously. But in advanced financial management, there is a massive difference between aiming for profit and aiming for wealth. You see, profit maximization is accounting-based. It's very short-term, and it dangerously ignores both risk and the time value of money. Actually, scratch profit. The true objective, the one that should drive literally all sound financial management, is wealth maximization. This means making decisions based on actual hard cash flows, factoring in risk and timing, and keeping a long-term focus. Ultimately, maximizing shareholder wealth, which really means your share price. That is your ultimate objective as a CFO.
Section 2. The gold standard, NPV.
So now that we know our main objective is wealth creation, we need a tool that perfectly measures it, right? Enter net present value, the absolute gold standard tool in the CFO's arsenal. But what exactly is it? Put simply, net present value is the sum of the present values of all future cash flows. So that's your inflows minus your outflows, less your initial investment. The key phrase to remember here is present value. NPV inherently respects the time value of money. It recognizes the fundamental truth that $1 in your hand today is worth way more than $1 tomorrow, mainly due to inflation, risk, and opportunity cost.
The golden decision rule for NPV is incredibly straightforward. If the NPV is greater than 0, you accept the project. Why? Because a positive NPV directly increases shareholder wealth by that exact dollar amount. It's that simple. However, while it beautifully considers the time value of money and links directly back to our main goal, it does have a couple of drawbacks. To calculate NPV, you need a highly accurate cost of capital, or discount rate, which can be seriously tricky to estimate. Plus, let's be honest, trying to explain discounted cash flows to a non-finance marketing director? Yeah, that can sometimes be a bit of an uphill battle.
Section 3. The percentage player, IRR. Because NPV can be such a tough sell to non-finance folks, executives often gravitate towards the internal rate of return, simply because it feels a lot more intuitive. By definition, the internal rate of return is the exact discount rate that forces the NPV of a project to be exactly 0. In other words, think of it as the project's exact break-even discount rate. If your cost of capital creeps any higher than this IRR, your project is going to start losing value. So the acceptance rule here is that you accept the project if the IRR is greater than your company's cost of capital. And its biggest advantage? It's just a simple percentage. I mean, everyone instantly understands a 15% return. But as a CFO, you have to be hyper-aware of the mathematical traps here. IRR carries this hidden, frankly unrealistic assumption. It assumes that as cash comes in over the project's life, you can constantly reinvest it at that exact same high IRR rate. And in the real world, that's almost never true. Also, if a project has unconventional cash flows, say, a massive environmental cleanup cost at the very end of its life, the math can completely break down and spit out multiple IRRs, which leaves you totally confused.
Now, if you're taking an exam and you actually need to calculate the IRR by hand, don't panic. You don't need complex algebra. You basically just use interpolation, which is a simple 3-step process. Step 1, you find a discount rate that gives you a positive NPV. Step 2, you find a higher discount rate that gives you a negative NPV. And step 3, you simply use the interpolation formula to estimate exactly where the rate crosses the 0 line between those 2 points. It's essentially just a mathematical educated guess.
Section 4. Resolving NPV versus IRR. Usually, NPV and IRR are going to give you the exact same accept or reject decision. But what happens when you have two mutually exclusive projects and they're giving you conflicting signals? Let's say IRR points to project A because it has a massive 30% return, while NPV points to project B. Who wins the battle of the metrics? Well, NPV is the absolute winner every single time. Here's why. IRR completely ignores the relative size of the investment. Think about it. A 30% return on a tiny $100 project is absolutely nothing compared to a 10% return on a $10 million project. You cannot pay dividends with a percentage. You pay them with absolute cash. Because NPV accounts for project scale and timing, it is the only metric truly consistent with wealth maximization.
Section 5. Rules for relevant cash flows. Let's see how this all builds together.
Okay, an appraisal tool is literally only as good as the numbers you put into it. Garbage in, garbage out, right? We need an instruction manual for feeding the correct data into our tools. And I want you to drill this exact phrase into your memory right now. Future, incremental, cash flows. If a cost doesn't meet all three of those criteria, it simply does not belong in your NPV calculation. It must happen in the future, it must be an extra cash flow caused solely by taking on the project, and it must be actual cash.
And this brilliantly illustrates where examiners and, quite frankly, the real world will try to set traps for you. Sunk costs, like money you already spent on market research last year, exclude them entirely. You can't change the past. Committed costs that you're legally obligated to pay anyway, exclude those too. Depreciation, ruthlessly exclude it. Because it is an accounting fiction, it's not an actual movement of cash. But opportunity costs, like the lost rent you'd suffer from using a warehouse you already own, those absolutely must be included. Why? Because that is a future cash flow that differs based directly on your decision.
Beyond just basic costs, you really have to carefully time your working capital and your taxes. When a new project starts, you're almost certainly going to need an initial injection of working capital to buy inventory, so that is an outflow at year zero. But crucially, remember to release that working capital at the end of the project as a cash inflow. As for taxes, remember your cash flows always need to be after tax. And watch out for the timing trap. Tax on operating profits is typically paid in the following year, so there's usually a one-year lag. Finally, while we completely exclude depreciation, we do include the tax relief on capital allowances. That creates a very real tax shield, an actual cash saving that definitely has to be factored in. So let's wrap this all up with a quick scenario. If a division manager excitedly runs into your office boasting about a project with a massive 25% internal rate of return, but your own analysis shows it actually has a negative net present value, do you accept it? Well, based on everything we've covered today, the answer is a hard, absolute no. Remember the golden rule, shareholder wealth maximization always wins. If the NPV is negative, it destroys value, regardless of how incredibly pretty that percentage looks. Stick strictly to relevant cash flows, trust the NPV gold standard, and you will make decisions that truly build wealth. Thanks so much for exploring the CFO's Toolkit with me today.